Hey, good morning, everybody, and welcome to this Trading Places Live. It's Tuesday, February the 17th, 2026. I'm Tom Boley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be with all of you this morning. Kind of an interesting week ahead because we got futures down a little bit and we're getting closer to support. And this is not a good week historically. So we're going to probably get another test of key support on the S&P 500 at that 67.97 level. And it'll be worth watching technology, the XLK, which has support at about 134, 135. And we're going to see whether or not we can hold. This is a critical level. I'm going to talk a little bit about the importance of some individual stocks in some areas of the market because of their weighting on the market, or on the key indices, the S&P 500, the NASDAQ, which are two of the indices that we follow pretty closely. And then I'll explain a little bit why the Dow doesn't have the same risk, the Dow Jones. Just the way the weighting is on the Dow Jones, it's a little bit different in terms of the stocks that are critical to that particular index. So let me go ahead and get this thing ready here for you. Give me 1 second. All right, let's take a look at what happened on Friday to get things started. And you can see the Dow Jones Industrial Average relatively flat, up 0.1%, 48 points, sitting back below 50,000. If you recall, we just closed above 50,000 recently for the first time in history. So we've kind of come back down a little bit below that level, but on a relative basis, the selling on the Dow has held up better than on the other major indices. S&P 500 up even less than the Dow, up only 0.05%. That was 3 points back to 68.36. Again, 67.97 is the level there. We'll look at that index and the chart in just a minute. NASDAQ, on a relative basis, performing among the worst of our major indices, dropping a little more than 0.2% on Friday, closing down 50 to 22,546. You can see mid caps, small caps doing much, much better on a relative basis. Small caps gaining more than 1%, although they did have a sell-off on Friday afternoon. They were up at one point, I think, over 2% for the day. So we did see a lot of selling later in the day on Friday. Volatility index, with the major indices bifurcated and somewhat mixed, the VIX did come down about 1%, but still closing over 20. And many of you, I think, if you've been following me for a while, you know I'm not a big fan of being in the market and taking on too much risk when the volatility index is above 20. I've done a lot of studying over the years, and when the volatility index is above 20 and rising, which is what it's been doing, the losses can accelerate pretty quickly. So you can start seeing much bigger losses instead of, a third of 1% or half of 1%. You can start seeing moves that can be 1 or 2 or maybe even 3 percentage points in a day on the major indices. And so I try to avoid the market as the volatility grows, just because, again, anytime volatility is on the move to the upside, when the VIX is rising and it's anticipating more volatility ahead, and higher VIX, higher volatility is associated with selling in the market, not buying. You don't have a whole lot of panicked buyers in the stock market. Folks, if the market's going up, rarely do you say, oh my gosh, I can't stand it anymore. I'm going to pour everything I can into the market now. It's not usually the way we work and the way our brains operate. On the sell side, it does work that way. You can't take anymore. The market's going down, down, down. You're starting to lose some money. And then it starts dropping 2, 3, 4% a day. And then you get a gap down the next day, and you do get to a point where you're like, okay, I can't take it anymore. That's it. I'm selling. And when enough individuals do that, you can mark a key bottom in the market. But that's not the way the tops form. So going to be a very interesting period. It's also worth mentioning, and I've talked about this before, I've done extensive research regarding the history of the market and how the market trades throughout the year, seasonally. And I can tell you from a lot of research that the second half of calendar quarters perform much worse than the first half. The only exception being the fourth quarter. Fourth quarter, the second half, first half, they're the two best halves of any calendar quarters. So I think Q4, the first half, I think is the best quarter. And then Q4, second half is the second best half quarter of the 8 half quarters throughout the year. So fourth quarter, forget about the fourth quarter. Historically, that's a great quarter. When we're looking at quarters 1, 2, and 3, however, the annualized return, the disparity between the first half of the quarter and the second half of the quarter, pretty significant. The first half of the quarter, actually, you're not going to be able to see this, but let me just go. I'm going to pull this up and tell you what the numbers are since 1950. I can give you a general idea, but I can actually give you the actual number if I look it up here on one of my spreadsheets. So for Q1, the first half of Q1, so we're talking about January 1st to February 15th, the annualized return for that period since 1950 is 12.9%. Now, the significance of that number, what you should compare that to, is the average annual return of the S&P 500 since 1950, which is above 9%, probably getting close to 9.5%, 9.4, something like that. So the first half of the first quarter is 12.9. So it actually performs better than what we normally see throughout the year. First half of the first quarter, very good. Second half of the first quarter is positive, but the annualized return is only 5.05%, a lot less than 12.9, which is the annualized return for the first half of the first quarter. So all I'm saying is that we've now shifted from that first quarter or first half of the first quarter to the second half of the first quarter, when historically the returns haven't been as good. They have been positive, some years better than others. I'm not trying to guarantee anything's going to happen based on history. I'm just pointing out tendencies and seasonality. So second half Q1, you do need to lower your bar of expectations because the market struggles a little bit. The other thing that you need to keep in mind is that we just wrapped up that October 28th to January 18th period, which is the most bullish period of the year. And the S&P 500 finished in the bottom quadrant of all years since 1950 when you just look at the October 28th to January 18th period. What does it mean by being in the bottom quadrant? Well, I break down that period over the last 76 years, and the bottom 19 years is the bottom quadrant. That's the fourth quadrant of returns. We just went through a period that falls into that bottom quadrant. And so historically, that tells us that the rest of the first quarter, we should not be looking for much in the way of gains. And so far, since January 18th, you've seen what's happened. We haven't really done much. That typically, historically, carries not only through the balance of the first quarter, but throughout the balance of the rest of the year. If you fall in that bottom quadrant of October 28th to January 18th performances, that tends to signal a not so great year ahead in the market. So these are things that we talked about at Market Vision 2026. Also, we had special webinars later in January, which dealt with some of these seasonal tendencies in the market. So you got to be aware of it. Doesn't guarantee us anything. None of these guarantee us anything. But when you start adding up every single signal from all different areas of the market, whether it be seasonality, sentiment, what's going on technically, the rotation that's taking place, all of this, when you add it all up together, it tells us we need to be really careful. So anyhow, let's get back over here. Check out sectors. So this is for the last week. This wasn't just Friday. This was the last week. Utilities, real estate, materials, energy consumer staples, industrials, healthcare. Those were the top 8 names. Notice I did not say communication services. I didn't say consumer discretionary. I didn't say technology. Those 3 are next up. And then finally, financials were really weak last week, dropping 4.81%. And if we scroll into over the last week, the financials, you can see insurance brokers down 8.7%. Banks, which had been so strong, falling 6.48%. So it wasn't a great week for banks, especially some of those large money center banks. What else do we have? I think that's probably it for there. Let's take a look at the S&P 500 chart. And I'm going to shorten this to 6 months. Let's really zero in here on this short-term support level that I've been talking about, 67.97. And you might say, well, what happens if we lose 67.97? Well, we just lose support. Doesn't mean anything, really. I mean, it could mean market bounces right back and we have a little false breakdown. That's possible. But you have to recognize the further you drop in the S&P 500, the stocks that make up the S&P 500, obviously some of them must be falling, and you're going to start seeing more stocks that are showing technical sell signals. So you have a lot of technical traders in the market, and the more that fall into a sell signal, the more shorting that takes place, and so selling begets more selling. So you got to be careful when we start to make breakdowns, especially with all the warning signs that I've been talking about. Remember, every warning sign that I bring up is secondary. They're all secondary signals to price action. I have always said, and I'll always say, price action trumps everything. So the warning signs start to tell us that there's more risk in the market. We get confirmation of movement to the downside when price action breaks down. So that's where we are right now. A lot of warning signs. It was just like the beginning of 2022, just like the beginning of 2025. I was warning both years that, hey, things are risky. We could see a correction. We could see, well, back in 2022, I was very convinced that we could see a bear market. I thought we were going to drop 20 to 25% in 3 to 6 months. We dropped 23% in 5.5 months. Pretty darn close. In 2025, I thought it was going to be a correction in the first quarter. We had the correction in the first quarter. And then the very beginning of April, of course, the beginning of the second quarter, we had a very swift drop, 10%, and it barely moved into cyclical bear market territory. If you look intraday, I don't think we ever closed down 20%, but intraday, I think we got down 20%. Then we rallied right back. So both of those years, the signals that we had, I think were pretty good signals. We got essentially the same types of signals this year as we had last year. Not quite as bad as we saw back in 2022. So we've seen some pretty good rotation. I still love the long term. So when I talk about being nervous, cautious about the market, keep in mind, I'm talking about 2026. I'm not talking about 5, 10, 15-year problem. I'm looking at something that's probably going to last. It might last 3 months or less, but my feeling is that we're going to be dealing with this probably maybe for the first half of the year and quite possibly even over the summer. I mean, it might be the fourth quarter before we really get going. But the big question is, do we break down? Do we break down, or do we just keep holding on to support and trying to meander higher and then we pull back again? Is it going to be this frustrating back and forth, or are we actually going to sell off, maybe go down on the S&P, test this double bottom, which was down below 65.50? I think we got down to about 65.20 or 65.25, something like that back in the latter part of November. If we lose 67.97, I think that opens the door, perhaps, for a much steeper drop. First, we'd have a little bit of support down around 67.25, but I really think the big one is 65.25, 65.30. Actually, let me see what that number is. 65.21 was the low. The low close was 65.38. So 65.21 intraday, 65.38 on the close. We're sitting at 68.36 as of Friday's close. Now, I can tell you that pre-market action, we got about 15 minutes to go to the open. The Dow Jones is down about 0.1%. The Spider is down 0.3%, so about 20 S&P points, which would right now open us at about 68.16. And again, 67.97 is the number, so we're getting close. QQQ is down about 0.2%. So again, the QQQ taking it on the chin a little bit. And then the small caps, which have been holding up a little bit better, down about 0.25%. So on a relative basis, it looks like the Dow and small caps, which are two areas that have been hit. We've moved down on both of them, but we've remained in uptrends, still look much better in those two indices. And both of those indices look better to me here in pre-market. So we'll see what happens when the opening bell rings. But the S&P is going to be down unless we have a change here in the next 15 minutes. We're going to be getting down close to that key support level. And on Friday, we did go down to 67.94. We went down just slightly below 67.97 on an intraday basis, bounced back. So the question is, if we go down there again today, do we bounce back? And the scary part is the volatility index remains above 20. So if you start losing price support and the volatility index is moving into really high territory where you can start to see much bigger sell-offs, I personally, like I've said, I just try to be cautious. I get questions all the time. Tom, are you still 100% cash? When I said I was moving 100% cash, that was our portfolios. And me personally, I did move to cash. I am trading. I hardly ever leave. Well, I can't say I hardly ever, but most days I am not 100% cash all day long. I will trade. Right now, I can tell you I'm pretty close to 100% cash over the weekend. Market was selling off. We're getting close to support. VIX over 20. I didn't want to take any chances. But if we open above 67.97, we test that level. We got some stocks out there that maybe are hitting support. Some stocks that are in some areas that have been leading the market. Might take a couple positions, probably be smaller than normal. But that's the way I'm just treating the market with a lot of respect right now. If I feel like we're in a market that's pulling back, but I love the market short term, I think it's going to bounce. I have no problems with my portfolios being left 100% in stocks. I just don't feel comfortable doing that right now. And I haven't since beginning of December. And the S&P is going to open today, according to pre-market anyway. We're going to open today about the same place what we were back on December 1st. We've gone nowhere. And mind you, December and January are two of the best months of the year historically. So we've just gone through two of the best months and we've gone nowhere. I told you that October 28th to January 18th, this has been not a good year. We're in that bottom quadrant. That's had a history of doing a pretty good job of calling what we're going to see over the balance of the year. I believe Wall Street starts to build positions during this bullish period, looking ahead. You've probably heard that many times. Stock market looks ahead. It's probably, well, in my opinion, it is the best leading economic indicator. And so when the stock market's moving up in October, November, December, and January, to me, it's really giving you a green light for the year ahead. That's historically the way the market has worked. Based on this last October 28th to January 18th period, I would say the market is giving us a yellow light, flashing a little bit of caution. Not necessarily a red light, not saying we're going to have a huge sell-off, but I just think there's going to be choppiness. And so far, that's exactly, look at the chart. Up, down, up, down, up, down. It's been nothing but chop. We're going nowhere. I think if we lose the support level, it could extend down to that 65.21 or 65.38, depending on whether you're looking at intraday or closing prices. But I would not be surprised. I pay more attention to the close. So for me, it would be 65.38. I wouldn't be surprised if we hit that, if we do lose the 67.97 level. Now, what I have said and what I said a week or two ago was when all that money started rotating into the industrials, almost every area in industrials on a relative basis is exploding. That normally doesn't happen right before you go into a cyclical bear market. So what I'm thinking is a lot of the cyclicals performing well, transports breaking out to confirm the Dow Jones. That's a Dow theory. With all of that taking place, it is strengthening my belief that the future, a year from now, is going to be very strong. And so it's telling me that the likelihood of a really deep drop this year, the likelihood is lessening, not that it's going away. Remember, when I see all these topping signs, to me, it's a risk assessment. I don't know of any signal that guarantees a 10% drop coming or a 20% drop coming. So I think sometimes when I, do my shows, that I'm taken very literally. And I think that's a dangerous way to take it. I'm just very cautious. I don't know how else to explain it or to describe it. I think in the short term, we've got issues. And so the question to me is whether or not do we have issues that are going to take us down to 67.97? Do we have issues that are going to take us down to 65.38? Do we have issues that are going to take us down to the breakout level on the S&P 500 back in April of last year when we went down to that, had that quick little cyclical bear market, then we rallied. We came back up. We took out a high of 61.44. Haven't gone back down there. So if we lose 65.38, to me, that brings in 61.44, which would be about a, 850 point drop, which would be about a 13% correction, something like that. So those are some of the levels I'm keeping in mind. 20% would take us all the way back to about 5,600. I don't see that. I think the odds of that are not very great. I'm not saying we couldn't go down there. I would probably put maybe a 5% chance of that happening. 61.44, I don't know, maybe 15%. 6,500, maybe 30%. And I would have said 6,500 back at the beginning of the year, probably 50%. So I still think it's a possibility. I just don't think it's as big of a possibility. And we'll see whether or not we make this breakdown. 68.90 or 67.97. That's going to be key. All right, then you have the NASDAQ 100 here, and I'll shorten this one to 6 months. This is a little bit more precarious because we already have lost the recent low that we saw back in middle part of January, right there. So we lost it. We went back up. We hit the moving average, and we've fallen back down again. Now, this is a little bit more bearish looking because in a downtrend, what normally happens is you lose your moving averages, you go back up, you test your moving averages, and then you break down again. Well, the only thing we haven't seen yet is another breakdown. We did test the moving averages, we failed, and now we're back down at this low again. Do we hold? Well, with the QQQ right now, 7 minutes before the open, down 0.6%. 0.6, let's see, 25,000. That would be 150 points, roughly. And we were at 24.7. So that's going to be 24,582. We're not going to, based on where we are right now, it doesn't look like we're going to lose support at 24.5, but we're going to be down there challenging it. So what happens today? Again, this is a bearish week historically. So everything's just telling me be careful. And I don't know what that means for everyone. And again, short term, it's very possible somebody who's long term could misinterpret this and say, oh my gosh, Tom's bearish, I'm getting out of everything. And then get out, and the market never really goes down much, starts going back up again. And those with a long-term mindset then have to make that difficult decision to buy back in higher. So what I have suggested to anybody who's long-term, doesn't worry about what's going to happen the next 6 to 9 months, is more concerned about what's going to happen in 2 or 3 years or 5 years. It's just my opinion. I'm not a registered investment advisor. You got to consult your own financial advisor for that. But my opinion is that this market's going to be higher in 2 years, 3 years, and 5 years. So from a long-term perspective, do you want to worry about what I think could happen over the next 3 or 6 months or even 9 months? I can't make that call. Everybody has to make that call for themselves. When, I don't, first of all, if we don't get a breakdown, we could hold, the S&P could hold right where it is, and we could take back off again, break out. That's a real possibility. I think the chances of us holding 67.97 and breaking back out again is just as high as us having a 20% cyclical bear market. It's at least 5%. Maybe it's 10 or 15%. So again, it's all about odds and probabilities and risk assessment. It's not about guarantees. I can't guarantee anything. I wish I could. All right. So do you want to know what the real problem with the market is? It's really simple. Folks don't really get how simple it is. I was just right before the show today, I went in and checked to see the percentages of certain stocks and the percentages they represent in the S&P 500. Well, first of all, NVIDIA is the number one stock in both the S&P and the NASDAQ at 7.83% and 8.90% respectively. Pretty big chunk. NVIDIA is a big name, and they're going to be reporting earnings soon. Anyway, NVIDIA, Apple, Microsoft, Amazon, Google, Meta, Tesla, and Broadcom. So the Mag 7 plus Broadcom. 37% of the S&P 500, 45% of the NASDAQ 100. So if those stocks are struggling, it's going to be very difficult for the rest of the market to offset it, to go higher. And that's what we're running into. Look at Apple. AD line, lowest it's been in 5 months. Price action, failed to get back up to the December high, rolling back over below its moving averages. It is at a 52-week relative low versus its computer hardware peers. Not good. It's not looking good against its own industry group, much less versus the S&P 500. That's number one. Microsoft. AD line actually wasn't bad, although it started to turn worse here in February on this selling. And look at the volume picking up on this selling in Microsoft. Now, Microsoft is probably the strongest of the Mag 7 stocks, strongest relative to its peer group, which is software. Unfortunately, if you know what's been going on in software, it's like Microsoft is the prettiest house in the ugliest neighborhood. If you can kind of get that visual, it's a really bad neighborhood. Software is horrible, but Microsoft, maybe it's got some little bit of green patch in its front yard. It looks a little bit better than the rest of the group. I wouldn't even say that the outperformance is massive. It's just slight outperformance versus software as a group. But software as a group has been getting clobbered. So yeah, this is what relative strength gets you in software. You're still falling like a, still got a falling knife kind of a looking chart. All right, next up, NVIDIA. AD line right now, probably the lowest it's been in 6 months. The good news is price action's been going sideways. The bad news is that semiconductors keep going higher, and NVIDIA, relative to its semiconductor peers, is near a 52-week low. NVIDIA is usually a leader in this space. So now you got NVIDIA, which is showing horrible relative strength to its peers. How about Meta? AD line's been going down for months. Got that big gap up with earnings and nothing but selling since. And the relative strength versus the internet group just in January hit a 52-week low, relative low. Bounced a little bit since then, but the overall group's been coming down a lot. So bouncing a little bit isn't really doing a whole lot. You can see it's actually going down. It's just not going down as much as the rest of the group. But it had been going down worse than the group most of the last 6 to 8 months. So again, not good. Google, look at Google. Probably the best of the Mag 7 stocks. I'm not going to say probably, clearly the best of the Mag 7 stocks. AD line looks good. Relative strength versus internet's been good. However, since earnings and really throughout February here, it has been going straight down. Volume is accelerated. The relative strength has started to roll over a little bit. Even Google, as strong as it's been and clearly the leader among the Mag 7 stocks, not looking good. By the way, the market did just open, so I'll try to get through this. We're going to go a little bit later today because I got a couple things I still want to talk about. Amazon, big gap down. Look at the volume. Look at the relative strength on Amazon. I mean, the Mag 7, say what you want about them. They carried the market throughout 2023 and 2024. Everybody said, well, that was a really bad market. You don't want to be in because there's no breadth. Breadth is horrible. Well, the S&P had a great year. The NASDAQ had a great year because these are the stocks that are very heavily weighted in those indices. So when they go up, the market goes up. I mean, if you're trading the S&P 500, the spider, or you're trading the QQQ, I'd rather have these six or seven or eight stocks on my side than the breadth, than the broad market. I want these stocks because look what's happening to the spider and the QQQ now when all of these Mag 7 stocks are struggling at the same time. Here's Tesla. Tesla's still holding on to price support. AD line just recently hit about a 5-month low. And then look at the relative strength. We're down near about a 10-month low, relative low. So Tesla holding up, but still not looking good relative to its peers. And then finally, the Mag 7 plus one stock was Broadcom. Broadcom, another big name in the semiconductor space. AD line right now near about a 7-8 month low. Looks like we're trending back down again. We just put in that low early February, went back at the 50-day, now rolling back over again. And check out the relative strength, not good. So those are all your big leaders in those two major indices. And Google is the only one, in my opinion, that looks good. And even that one is starting to show some wear and tear. So here are 8 stocks. It's that simple. If these 8 stocks keep trending lower, I wish you the best of luck in the market. That's all I can say. I don't care about breadth. Everybody's been talking about how breadth has been so much better. Why isn't the market going up? So if you want to know why I don't talk about breadth, it's a market cap weighted index, folks. S&P 500 and NASDAQ. It goes with those higher market cap companies. It doesn't go based on breadth. The breadth can help hold it up a little bit, which is what it's been trying to do. But as far as making money and getting the market to go up, I'll take these 8 stocks and you can have breadth. Dow Jones, this is a different breed of index. This isn't based on NVIDIA and Apple and Microsoft. Even though they're part of the index, that's not the way the Dow Jones is calculated. Would you like to know the way the Dow Jones is calculated? Here are the components, and I have them listed in price order, not market cap order. Here's market cap over here. So if I pulled up the market cap, you would see NVIDIA, Apple, Microsoft, and Amazon. But that's not the way the Dow is priced. The Dow, the stocks that carry the most weight are the stocks that have the highest stock price. Goldman Sachs is your number 1 stock. It only has a market cap of $284 billion, nowhere near the trillions that we saw in NVIDIA and some of the others. Second stock, Caterpillar. The only one that I just mentioned of the 4 big names that are in the Mag 7, the only one I mentioned that's in the top 10 or 15 is Microsoft. Its stock price is $401. Then we've got Home Depot, Amgen, Sherwin-Williams, American Express, McDonald's, Visa, JP Morgan, Travelers, United Health, IBM, and then we hit Apple. So if you want to know why the Dow goes up and the others go down, it's simply based on what makes up the index and what carries the most value within the index. The Dow isn't weighted down by those Mag 7 stocks. And then you get into something like small caps and mid caps. They don't own any of the Mag 7. You're talking about much smaller companies. And the risk is spread over a wider range. So when you do have breadth, when you have solid breadth, that's going to be much better for the Russell 2000, the S&P 400 mid cap, and even the Dow Jones, because again, the Dow Jones isn't weighted based on market cap. Completely different. All right. For those of you that are new to Earnings Beats, first of all, please like our video and subscribe to our channel. Yes.
Would you refresh that page real quick?
Sure. Yeah, I'll go over this. I was going to talk about it. But if you are at Earnings Beats, or if you've been watching the video, please hit that like button and subscribe to our channel. That can help us as far as the algorithms on YouTube. So even if you don't become a subscriber, you can help us if you enjoy watching our shows. So hit that like button, hit the subscribe button, turn your notifications on. We do a lot of live stream events. And if your notifications are turned on, YouTube will notify you when we do a live event. You come in and join us. So that definitely check that out. Now we got a couple things coming up this week for our paid members. First, we've got our Max Pain event, which is today, later today. I think it's 5 o'clock, where I will give you stocks. First of all, I'll give you the direction I think the market could move in based on Max Pain, based on where all the options fall. What would behoove market makers to move prices up, to move prices down as we go into Max Pain week? It's uncanny how options can help determine the direction. Last month was crazy good as far as giving us a heads up of which way the market was going to go. So you can definitely check that out. But the bigger event is going to be tomorrow, Wednesday, February 18th. It'll start at 5:30 p.m. This is where we draft our stocks for our portfolios. Now, in our portfolios, we moved our portfolios to cash back at the beginning of December because I honestly didn't like the way the market was starting to shape up. I didn't like the way the money was starting to rotate, and that rotation has only grown more and more bearish since that time. And like I said, S&P 500 has gone almost nowhere since the beginning of December, where typically this is one of the strongest periods of the year. Normally, we'd see a pretty big move to the upside. So I think it is giving us a little bit of a warning. So this quarter, when we go to fill out these portfolios, I'm going in with a lot more knowledge about where we stand in terms of rotation. Those growth stocks, software has been getting killed. It was a good thing I pulled those software stocks off the table back at the beginning of December. I can tell you that much. But our overall portfolios have done exceptionally well. So if you click on this link at our website, it'll bring you over here to a page where you can register for the event, become a member, and you can become a member with a 30-day trial. But anyway, here you can click on that register now. Check out our gains on our model portfolio, up 327.5% since November 19th of 2018. The NASDAQ, which has clearly been the best index, can't even keep up with our model portfolio. The S&P 500, we more than doubled the S&P 500. We've gone through 4 cyclical bear markets. So we have not exactly been investing in the easiest stock market, period. There's been a lot. We've had a pandemic. We've had 4 cyclical bear markets. We've had another correction, all in a little over 7-year period. And yet we've more than doubled the S&P 500. So there's something to what we do, which is basically filling our portfolio with leading stocks and leading industry groups. But it's also kind of paying attention a little bit to what's going on around us and paying attention to the rotation. So I've got some thoughts, not only about the stocks that go in the portfolio, but maybe about considering a redraft somewhere during the next 90 days. Normally, we get into a portfolio and we hold for 90 days. But because of this rotation, if it switches, I think we want to leave the door open to possibly reallocate within our portfolios. Anyway, I'm going to talk about all of that tomorrow at 5:30. So if you want to join, go to earningsbeats.com, click on the link for the top 10 stock picks, and then hit that register now button. You will not be disappointed. Last thing I'm going to do, I know we're 10 minutes over. I do want to just show you, this is our strong earnings chart list. And generally speaking, this is where all of our picks come from. We go with companies that are beating Wall Street estimates. So they've got to be doing well fundamentally. They also have to be doing well technically. And you can see in our strong earnings chart list, I'm listing the stocks in scooter order, which is the stock chart's technical rank, which gives us a relative strength indicator. I mean, I follow it a little bit differently, but this is a good indicator to put on one of these summary lists so that you can kind of get an idea of how many of these stocks have performed relative to one another within the same asset class. So it's going to group stocks in the large cap arena against one another. Then it's going to group stocks in the mid cap arena against one another, and then small cap. So you might have a small cap that might not be doing nearly as well as large cap, but they might both be well up in the 99s, because if you're looking at a small cap, you're looking at it relative to all the small caps. Doesn't matter how it's doing relative to the large caps. So keep that in mind. But I mean, this is the list I'm going to be starting with. I'm literally going to be going right down the line, looking for stocks that can provide us outperformance over the next 90 days. And I'll discuss all of that, the themes, what we're going to do, whether we're going to redraft, how that could possibly look and unfold. Going to talk about all that tomorrow after the close and at 5:30 when we unveil stocks that'll be in our model portfolio, aggressive portfolio, and income portfolio. So that's what I have for today. Let's go ahead and take a look at what is going on in the market. Got an update right now. So the Dow's up a little bit, S&P up just slightly. So remember, futures were down. We held on to the support level so far. S&P bouncing back. That's kind of been the history. We'll see whether or not that takes place throughout the rest of the week. We do have a couple economic reports. I know the PCE index comes out on Friday. That's one of the inflation gauges that the Fed likes to follow. So that'll be out on Friday. We've got, I think, housing starts and building permits, I think 2 months worth coming up later this week. And then we've got in earnings, I can give you a few companies. Tomorrow morning, we have Analog Devices, a big semiconductor name, Moody's in the specialty finance area, Garmin, recreational products company. Those three will report, along with many others, by the way. Those are three of the biggest names. That'll be reporting Wednesday morning. After the close on Wednesday, Booking Holdings, Carvana, and DoorDash, among probably another slew of 50 or 75 companies that will be reporting Wednesday evening. Thursday morning, Walmart. That's been one that's been very strong and is weighted almost kind of along the lines of those Mag 7. Walmart's a big name. So that'll be a big report on Thursday morning, along with Deere, which has been doing much better. And then Thursday evening, we're going to get a gold mining stock, Newmont Mining. Be very, very interesting to see how Newmont reports and the market reaction that we get to that. So those are some of the big names in terms of earnings later this week. Anyway, that's it for me. I know we went a little bit over today, but I did want to give you a little bit extra, given some of the things that I think really help drive the market. So with that, I will sign off. But again, check us out. Come join us for our portfolio draft. You sign up for an annual membership, you're going to get the next 4 quarters along with next year's market vision and everything else we do, all of our chart lists. It's well worth the subscription. I guarantee you're going to learn a lot over the next year and hopefully feel more confident about your financial future. Anyhow, have a great rest of your day, everybody. Happy trading.